G'day, Bico Konstantinos here, and today we want to talk about the first thing that you need to consider if you want to start trading or investing in the stock market. My name is Bico Konstantinos, and my goal is to support your trading and investing decisions through up-to-date market analysis and education. Please like this video, consider subscribing if you find my content valuable, and hit the notification button so you don't miss any new content. Also, I'm very interested to hear your comments. If you agree, if you disagree, if you have any other thoughts, I'd love to hear them. So the first thing to consider when getting into the stock market is whether or not you want to be a passive or a proactive investor or trader. Let's start with a passive investor. So if you are passive, what that pretty much means is you just want to invest into the stock market, but you want very little risk and you don't care about time frames. So what that means is every time you get some extra money, you'll invest into the stock market, and you'll just do that whenever you have the cash. If possible, you might make a regular contribution, and that would just come out of your pay or a regular monthly contribution, and you would invest into the stock market, whether it's going up, whether it's going down, no matter what. When you have the money, you're going to continue investing. Now, the instrument or the stock that a passive investor would normally use would be what we would call an index following type instrument, which are usually an exchange traded fund, or for short, an ETF. So what we mean by that is it would be an instrument that would actually follow or mirror a broad index which covers a lot of shares or a lot of stocks. So for example, the S&P 500 US index, it covers the top 500 capitalized stocks in the US market. So if you were to buy an ETF that follows or mirrors the S&P 500, basically your returns would mirror the S&P 500 as a group. So the combined returns of the S&P 500, however they're weighted, then that would then, your investment would follow that. So a passive investor basically would be investing into, if you were wanting to use the S&P 500 example, every time they had spare money, they'd just be investing it into an ETF that mirrors the S&P 500. So if you look at a chart of the S&P 500, whatever date you are investing, wherever that price is on the chart, then that's what you'd be investing at. And so the whole idea of passive investment is it's very difficult to time the market. So basically the easiest way or the simplest way is just to invest in something safe like a broad index like the S&P 500, or in Australia it would be maybe the ASX 200. So you're investing in an instrument that would just follow the broad market index for whichever country you want to invest in, and that would give you an average return however that index goes, however the broad group of the ETF that you're investing into, whatever performance it has, then you will get. And you can also get advantage of an average dividend, like a weighted dividend of whatever that index provides. And so this can be a very safe and a very worthwhile strategy, especially considering that broad indexes in general have produced very good returns. If you look back 20, 30 years, over that period, yes, there's been dips, but over that period it produces very good returns, and it's sort of geared to do that because, for example, if you were looking at the Australian ASX 200, what happens is some of those stocks that are in that group of 200 most highly capitalized stocks, once they lose their capitalization because they're going bad, they'll drop out, and then new stocks that gain market capitalization will enter that 200. So it sort of weeds out those companies that start going a bit bad, and they're not as highly capitalized, and it brings up the new companies that are more capitalized. And that's one of the advantages that usually would see that ongoing increase and that ongoing return. So over a long period, usually your returns are quite good, and it's a very good way of being a passive investor, that you don't have to worry about any sort of timing. You just continually invest. Hopefully, if possible, you'd do it regularly, because that way you wouldn't miss out on some of the big gains. If you could only do it, say, once every 6 months or 12 months, you might miss out on some really good gains and some really good some entries, and so your returns may not be as smooth that way. So if you can set it up regularly, fortnightly or monthly, that gives you the most smoothest return if you're looking at passive investment. So if you wanted to take a more proactive role in the stock market investing or trading, what we'll be looking at is more about when you would enter a position, when you would exit a position. You would also look at a broader range of instruments. So you might look at not just an index following or index mirroring type ETF. You'd look at all sorts of stocks, and you'd look at all sorts of types of stocks. So for example, categories. By that we might mean resources, industrial stocks, financial stocks, technology stocks. So basically you're trying to, if you're a proactive investor or trader, you're trying to maximize return. And the only reason you do this is if you feel that you could beat the market average. So if you want to spend the time, if you want to educate yourself, if you want to learn about charting, about entries, about exits, if you want to learn about trading strategies or business type strategies, then you'd become a proactive investor or trader, and you'd be looking to get returns that are higher than just the actual index. So if the index has risen on average maybe 8 to 10% over the past 10 or 20 years, you'd be wanting to make more than that, especially for the added risk. So the whole reason to become a proactive investor or trader is that you're looking to make returns more than the passive investor who's just following an index, a broad index. So when you're considering whether or not to be a passive or a proactive investor or trader, you probably need to weigh up certain things like how much time you have to invest in yourself to learn about the stock market, to learn about the different instruments, to learn about entries, exits, to learn about charting, also fundamentals. How do you research different stocks? How can you tell if they might be a good investment or not a good investment? Also trading psychology. So how do you work out what's the best psychology to be able to use when you invest your money? Because when you first start in the market, as soon as you have put real money into the stock market, you're going to be watching that market very closely. I guarantee it. Most people, when they start off, they'll be watching the price day in, day out, because that's one thing the stock market does. It gives you daily price action. It's not like real estate. You don't know exactly where a real estate is priced on a day-to-day basis, but the stock market will give you an actual figure. Every day, it'll show you the high for that day, the low for that day, and it'll show you the closing price for that day. So each day you can see the new closing price, and it takes things to a new dimension. psychology becomes involved, because when you're doing well, you start thinking, oh, this is great, or this is easy, or this stock's gonna be a winner for sure. And that can play in your overall decision making, because that might make it harder for you to exit a position if you have a strong attachment to a position. And there's many other factors. So if you are wanting to be a proactive investor or trader, you need to consider how emotions are going to play in your investment and trading decisions. And one thing that I want to really highlight the importance of is that trading psychology or investing psychology. So the way that your mind works can sometimes be to your detriment. So what you want to be is cold. What I mean by cold is not getting hot or highly emotional. So you want to be cold, you want to be disciplined, you want to have pre-planned ideas of how you want to manage your trades. Pre-planned ideas of how you make an entry decision, so how you open a new position, how you make exit decisions, and all those sorts of things. We also want to pre-plan your strategy. So if you are being a proactive investor, are you looking at, shorter term swings? So maybe 1 month to 6 months. Are you looking at buying but just holding long term? Things like that. So there's many factors to consider. Now it can be very worthwhile. I myself enjoy being a proactive investor and trader, but it's going to be very emotional. Certainly once you've got your money in there. Now, the better you can handle your psychology, the better you can handle your mind, the better you will do in the long run. And there will be always ups and downs. So you never ever, if you do it over a period of time, it's never ever going to work always in your favor. So it's just something to consider, that there'll be a lot of factors in play when you become a proactive trader or investor. Definitely can be worthwhile, but just be ready for a journey. Be ready to constantly try to look at your performance, analyze yourself and how you've managed each trade or investment, and just try to improve. Just try to improve, and it doesn't mean that you won't have losers. You'll always have losers, but if you've managed that trade well, in my opinion, you've done very well. So that's what some of the initial thoughts are for proactive investing. So once you've decided if you want to be a passive or a proactive investor or trader, then it's just a matter of start doing it. So I would recommend just start small, because once you actually do it, then it will start that learning process. Now, if you're a passive investor, there's not really anything that you need to do in regards to research. You just choose your instrument or instruments, and you regularly will invest into those, and you hopefully will start reaping the rewards of the returns of that index that you're going to follow, index or indexes that you're going to follow. And then you just keep doing that as much as you can, put money into that, and then over a long time and compounding returns, you should do very well. Now, if you want to be a proactive investor, just do some research, choose a stock or any sort of instrument you want, and then start investing small, start getting a feel for it, and just go from there. Start the whole learning process. There is many other factors that I will talk about, and many other people have talked about for proactive investors and traders. But yeah, just start, and that will start your learning process, which I hope, if you do want to do that, is a very rewarding one, both financially, both in education-wise, and hopefully you'll be able to realize your goals. But just in anything, the harder you work and the more disciplined you are, usually the better your returns will be. So just consider that. It's not If you don't want to put in the effort, then you may not see the rewards you're hoping for, or you might see them short term, but if you continue over a long period, then that's when you'll always face some difficulties in the market. I'm Biko Konstantinos. Thank you very much for watching my video. Please consider subscribing to my channel, and I would be really interested to hear how you have gone in regards to your trading and investing. Are you wanting to do passive? Are you wanting to be more proactive? And how you went starting off. I'd love to hear your comments. Thanks, and see you later.